We have a fair value gap in the form of a sell side imbalance, buy side inefficiency, with only this little area remaining. So because it didn't completely reprice that, this is the exposed area of inefficiency. And buy side liquidity or buy stops will be resting just above this. I'm showing you the new week opening gap high and low here. And here is that weekly fair value gap. You can see that we ran up initially to take the buy side, make an attempt to completely reprice to the SIBI high. So all of this movement here was a sucker's play. Retail traders that bought all this, unless they were nimble and got out, they got caught off guard and offside. Notice the use of the new week opening gap here and here. All right, moving down to a 5-minute chart. Here's the brass tacks of today's delivery. New York opening midnight price. That is this candle's opening price. That's extended throughout the day. The market rallies at 9:30, trades up to the buy side liquidity pool that I showed you on the 15-minute time frame inside that 15-minute fair value gap SIBI. Let me take you back up one slide and just make sure you know what I'm looking at. This area over here and this high, that's that line here in that shaded area. So we're zooming in on a 5-minute chart inside this price action right here. That's this on a 5-minute chart. So the algorithm is going to reprice to a premium to some random level, no, to reprice up to an old inefficiency, and the best shorts are above the opening price at midnight New York local time. The market rallies up multiple times. Then we also have, what is this over here? The buy side liquidity. Why am I picking these highs here? Because I just taught you with the lecture from last week, one setup for a life. What I did in that lecture was to teach you how to find a setup that will serve you for the rest of your life. And I teach you how to look for liquidity. What specific liquidity am I referring to? All of this run here is a Judas swing. A Judas swing is what I dub a false run that gets people to chase it. They get offside. It goes to a very specific price PV array. The element is what? We're going to enter a sell program. It's going to go to a very specific price level. Running out buy side here. What kind of buy side is that? London session liquidity. Then we have the low of the London session. What is that? That's the London session sell side liquidity. So notice how the market at open at 9:30 rallies up, sucks everybody in thinking it's going to go higher. If you're bearish, the best short entries are going to occur at the price, not the time, the price of New York opening price. What time? When is the Judas swing going to form? At 9:30 to 10 o'clock. That is your opening range. Counterparty, London session, liquidity. Aiming for London session, liquidity. This is the opening range gap. Okay, and what you're looking at is this candle here is Friday's data. And you're going to be showing this on your trading view chart with regular trading hours needs to be toggled. This price here, the close, is what's being shown for that candle right there. So at 4:14 p.m., Friday, June 23rd, 2023, the closing price is 4,388 even. Then you're going to wait until 9:30 in the morning, New York local time, when the market starts trading regular trading hours. So the difference between the closing price on Friday and the opening price on the next trading day or Monday, that is the opening range gap. Whenever there's an opening range gap lower than Friday's close, we are opening with a discount opening range gap. If we are opening with a gap that's above Friday's close, we're opening with an opening range gap premium. So now that we have the opening range gap defined, let's take that information and apply it to the 1-minute chart. We can see that rally here at 9:30. All of this is a Judas swing running out above the buy side liquidity in the London session. You'd see this with the electronic trading hours down here. So the market rallies up into that premium fair value gap in the form of a SIBI and that buy side liquidity here. And we're trading above the New York midnight opening price, which is this level right here. We have a more definitive drop here where we've taken out this low, and we have a fair value gap right there. You could have used this one to enter, but you would have had to use a stop that factored in this fair value gap. So that means you'd have to have a stop loss above that short-term high. I didn't like that. Price ran up to it once more and then broke. Now, because we had a shift in market structure here below that low, you could have used that low. There's nothing wrong with that. But that high wasn't pierced by this high. And then the only thing it was doing was running one more time above the New York midnight opening price and back inside that fair value gap SIBI. So it's one more time running into a premium. Then we broke down and we had two gaps here. This one that's shaded in yellow and this one here. So consequent encroachment, I placed my stop loss just above that. Why did I do that? Because we've already proven algorithmically that we're not going higher. So just drop down. Even though it didn't take out that low, I have to use the 2 rule. When there's 2 gaps, you have to factor in the higher gap. So the shift in market structure, then even though it didn't take this low out, it didn't need to for me to enter. And I'm entering inside this. So I'm going to anticipate the algorithm repricing back down into the opening range gap. So this is a repricing macro. All of this is a Judas swing. Take the low to the high, find equilibrium. What PD array would be a discount array below 50%? There is a gap here. So I was looking for it to trade towards the opening range gap and trade into a discount, and I just used a imbalance there and worked below the new week opening gap low. Now, if it would have been a day trade that I could have been managing, I would have taken additional entries, which is what you watch me highlight in the review video where I'm showing this fair value gap here, and I actually put a limit order there. So that was a mental marker for you to know that I'm referring to that as it's number one, it's an additional entry that you could have used, or a pyramid, and then aiming for this lower end target at 43.70. So here is the 1 minute chart zoomed in here. The opening range gap, the Judas swing up. We have buy side liquidity. This is Friday's New York session liquidity. This is another factor and the reason why I wanted to wait and I didn't take this one here. Buy side liquidity rallied. Would have been fine if you had it stop here. We're dropping two fair value gaps here and here. I'm going to try to enter this one and I'm going to use 50% of this fair value gaps range, and the stop would have to be above that. It drops down, goes back up into a fair value gap, which is a SIBI, sell side imbalance, buy side inefficiency. It trades up into it once more. That would have been an additional pyramid entry, and I would have had to hold on through the entirety of the lunch session and anticipate a run back into new week opening gap, which is what we see here. Perfect consequent encouragement. All of this run up here is the Judas swing. Now, you can and you could have taken some of this move here, and that's fine. If you would looked for these ideas to get short or sell your long position, both instances are correct. We had two forms of liquidity. We had the London session, buy side, and we had Friday's New York session, buy side. Fair value gap, using just the silver bullet mentality back inside of the opening range gap, but more specifically, using a run below the new week opening gap low. Now, I taught you in that one setup for life, I teach you liquidity. If I'm bearish and notice that we did not get down to that 43.70 level, did it get to the 43.70 level yet? No. What do we have here? What's this? The opposite of this. So if this is New York lunch buy side liquidity, okay, what's the highs? Where's the liquidity at during the lunch hour? Well, here's noon here. So we have a high here, we have a high here, and we have that opening range gap, which is that shaded area. So it makes perfect sense for it to do what? Reach up into half of that yellow shaded area, right? So that's reasonable. Why would it be possibly advantageous to see price do that? Who would be better equipped to make a trade with that idea? Shorts. So smart money can wait for the algorithm to reprice back up into half of the shaded area or just above these relative equal highs. So the algorithm runs quickly to get to that level, and then it spends time here until we get to what? The 315 to 345 market on close algorithm. 315 to 345, boom, attacking the opposing side, sell side liquidity of the lunch hour. Go back and watch the one trade setup for life. I promise you, if you listen to what I'm teaching you there, this is exactly what I have been doing for years. Every single time I take a trade, I've used the logic in that teaching. That's the lesson that you're looking for. That's the one. Because if you understand what I'm teaching you there, you will never run out of setups.